So the second sort of major set of third, I guess, the cash statement, cash flows, financial ratios, and now we're going to talk about operating indicators. And operating indicators typically use a mixture of operating and operating data or financial and operating data to help explain the financial data. So if I tell you that your profit went up last year, you can say that's great, but you really don't know why. So the operating indicators will be indicators that help you understand what might be driving some of the financial indicators. So a couple of examples. Lou calls this net price per discharge, which I always have these running arguments with him because I really think it's revenue per discharge, but he likes to call it net price per discharge. Essentially what this is saying is taking your total net inpatient revenue divided by your total inpatient discharges and getting 5128. What does that mean? An average of 5128. The industry average is 5510. So what does that mean? What does that tell you? So why? What would you do with that information?
Try to decrease your expenses or costs. Increase your price. Or consider the services again.
Sorry, what was the last one?
Kind of look at the different services you're offering.
Right. There could be all kinds of reasons there. Certainly it could be revenues, it could be costs, it could be the types of patients you've got. This tells you something, but it requires a lot of information, a lot more information digging to find out what it means. Another one is occupancy rate. Inpatient days over staff beds times 365. 57.9%. What does that mean? Is it the number of beds, or it's the percentage of beds that have a warm body in them at on any one day? So what that means is if this were a 100-bed hospital, if I walked through the bed on any day of the week, on average, I'd see 58 people in those 100 beds. The industry average is 45%. So how do you interpret that? You'd say over-occupied, okay? How would someone else interpret it a different way? Josh?
Well, I mean, I'd be happy about that. I think I don't know what's.
Why would you be happy?
Or not, but
why would you be happy?
Just because you're doing 14% better than the industry average.
But depending on that constrains other resources or operations.
How would it constrain it? Tell me what you mean.
Or put strains on it, like if your staff is overworked, they're having to be paid overtime to service the higher percentage of occupied beds.
So you would say you want to look at this in relation to the costs. That's reasonable.
Would there be issues if this was at 99%?
Would there be issues? Would you care to expand upon that, Brian?
Well, some of the ones that Amy was talking about, if you're always at capacity, that could have some long-term consequences.
Mm-hmm. So if you're at 99, okay, Robbie?
I was just going to say that I think this is good because you're spreading out your fixed costs across more inpatient stays.
Right, so you've got a physical plant, and the higher the percentage occupancy, the more efficient you are in the utilization of that plant. But I'd like to come back to Brian's point. Suppose occupancy rate is 99%. What is that 99%? It's an average, right? And what goes into an average? Highs and lows. So if the average is 99, what is it going to be on some days? Is 110% occupancy rate on any particular day a good thing? It may only be for a day or two. I mean, there are all kinds of issues around that. I mean, and it really depends also on the kind of organization. If you walk through a nursing home, what about 99%? Would you be worried? It's not a trick question. I don't think so, because most people are there for long time periods of time. And so if you've got 99% occupancy, that's probably just fine.
I was going to say, it might be a little sensitive because you can't really affect when people leave.
Yes.
It's not like you can change that.
There have been movies made about people that were required to leave before their time. But it really depends on the level of what kind of organization it is. One thing I can absolutely guarantee you, if you've got a 99% occupancy rate, you have the most dissatisfied nurses in the country. Because they are going to be working like gangbusters and they will be not happy. So the issue then is 20% everybody's sitting around playing cards, not enough to do, not enough patients, but 99 is too high. What's the right number? I can't tell you that. Somewhere between 20 and 100. Some of the limitations of these kinds of analyses. Comparison with industry averages is difficult if you've got a lot of different divisions, or if you're in radically different markets, or if you've got significantly different kinds of product lines. Average performance is not necessarily good performance. What does that mean?
Like what we just talked about, the occupancy rate being a little bit higher than average is a better thing. So it doesn't mean that average is like our target. We don't want to lower occupancy just because the average is low.
Okay, Sarah?
Well, I would say a similar thing with that example, which is that if in your market share, there's not a lot of patients and there's not a lot of volume, you don't want to be at average. You need to figure out a way to tap into a new market share.
Okay, let's think about profitability for a second. Can anyone think of a circumstance in which average performance is not necessarily good performance?
Well, like with the capacity example, I would assume that the average is taking sort of critical access hospitals and urban hospitals. So your average, or the average for the whole group would be way different depending on what sort of circumstances your organization is in.
Okay, let's talk about circumstances for a minute. Cast your mind back to 2009, height of the recession. The average hospital margin in 2009 was -2%, -3%. Is that good performance? You can't survive with -3% over the long run. Anybody can survive for a while. But the average performance was not very good. If everybody in the industry is losing money and you've got a total margin of 1%, you're doing great. If everybody else is making 15, 20% and you're making 10%, you're not doing so great. So comparing with averages is really a moving target. The averages go up and they go down. Sometimes it's hard to tell if a ratio is good or bad. Is average collection period 40 days is worse than 30 days? But again, depends on what's happening. If you've just gone to NC Tracks, it's probably doing pretty well. Jennifer.
So when that happened, did they, I mean, I know that the operating margin's lower, so your revenues probably are lower, but did the industry as a whole see days cash on hand increase because people were scared and wanted to have more money with them opposed to in assets, or, I mean, in infrastructures? Did they see a trend like that, or was it pretty constant?
In 2009?
Well, I guess 2010, like the year after.
And basically, if you look at the data, everything got worse. Assets went down, cash went down, investments went down, income went down, revenue went down. Nothing improved. There was, you can't increase days cash on hand if you're losing money. You're not generating enough, if you're not generating net income. So it's only now in the last year or two that these things have begun to turn upward again. And even so, the Standard & Poor's outlook for a lot of healthcare organizations is still pretty neutral to negative. Did I answer your question or not?
I guess I was just thinking that like now people would have more days cash on hand because they'd be more scared to be without that extra margin. Because like the recent issues that they saw. But I mean, I get what you're saying, that you wouldn't have that money to do, but I'm saying like in future planning, would you see some of those averages that used to be a little bit lower be more conservative in nature?
Well, keep in mind, remember what days cash on hand is. It's taking cash and marketable securities. So that's liquid assets to meet your current bills. It's not saying, it's not your profitability. They may be generating all kinds of cash, and they only keep a little amount of it in your bank account because all the other cash are going into long-term investments, which is where they should be parked because you get higher rates of return on that. So days cash on hand really is a measure of cash management versus how well the organization is doing at producing cash. Now, did I answer it or not? I'm still circling at 50,000 feet here. Robbie?
So like, even if they got scared and liquidated their short-term securities, it's not changing your days cash on hand because that's already included in the numerator, right?
If they liquidated their securities,
They're short-term.
short-term securities, and used it to pay bills, that will draw down because that's in the numerator.
No, I'm just saying if they just converted it to cash.
Then if it's a one-for-one exchange, the numerator does not change. Everybody see what he's saying? If you've got cash, you've got marketable securities, they're both in the numerator, the current ratio. They're both cash equivalents. So if you move money from marketable securities into cash, you're just changing it from one current account to another current account. The current ratio does not change. Other limitations, different accounting conventions, seasonal factors, inflation. When you're in a period of high inflation, financial statements can become very distorted very quickly. And then finally, window dressing. What do you think that means?
Choosing which ratios meet the organization needs.
Yeah, and choosing to make certain financial statement decisions that alter the view of the organization. Like, for example, prepaying expenses. You can move expenses from one year to another year. There are different practices that where you can move things from one year, one reporting period to another. The economic value added, as I said, I do not see this used a lot in the real world, but I think it is interesting to talk about how we can affect different kinds of financial indicators through different kinds of management strategies. So we've got earnings before interest and taxes. If we want to increase that, we want to increase the reported earnings before interest and taxes on the financial statements. There's several ways to do it. Increase revenues, your sales volume, or increase your prices. Or you reduce operating expenses by labor productivity improvement rate, lower wages and benefits of supplies, and overhead costs. So that's the easiest way to change the reported earnings before interest taxes, either increase your revenues or decrease your costs. Reduce taxes if you're an investor-owned organization. In terms of capital, if you can get the same level of volume of business with lower levels of inventory and lower levels of receivables, that's a good thing. Or if you reduce the fixed assets. If you decide if you're operating at a 40% occupancy rate, you may want to think about closing 20 beds and saving the operating costs and the fixed costs of unused capital. Reducing the cost of capital through less fixed costs and more variable costs. optimizing financing mix between short and long-term debt. And so that sort of just tells you the kinds of things that management can do to actually affect these kinds of different financial ratios. Benchmarking is something that you hear a lot of. It's done a lot in financial statement analysis because lends itself. It's easy to do. Everybody calculates total margin the same way, net revenue divided by total revenue. So here are some examples of the kinds of benchmark data you can get. In terms of 2010, Riverside here has a total margin of 7.3%. So it can tell that it's not doing as well as it's not in the top quartile, but it's doing better than the median. So it's somewhere between the 50th and 75th percentile, which is pretty good. Maybe it knows somebody in national GFB that it can contact or read about, find information about how they're doing what they're doing. Key performance indicators and dashboards. So you hear, again, these are buzzwords that you hear a lot of these days. Key performance indicators are essentially a small number of financial indicators that are measure the performance that is absolutely critical to the success of the organization. So at Piedmont, I helped with the CFO, I helped them develop their dashboard, which has got 13 key performance indicators on it. So, and I sat down with the finance team and basically said, what factors about this organization drive the profitability of the organization? And we came up with, medical revenue per day, number of medical visits per physician, those kinds of basic metrics. We now have those every board meeting. We have the 13 indicators. We got 25 pages of financial statements. But we also have these 13 indicators, which really allows management teams and boards to focus on a small number of indicators that are really driving the financial performance.